Ciao guys, welcome back to Lorenzo to Sense podcast. Today is the third of the 4 episodes in the series Invest in AI and Avoid the Bubble. And specifically, we are exploring the category AI infrastructure. Please remember that this is not financial advice, so do your own due diligence and let's get right into it. This category is the one that most closely tracks AI capital expenditure and will likely deliver the most satisfaction in the short term. And this category isn't the safest. That's why it's only about 10-15% of my portfolio. If AI capital expenditure cools down over the next few months, then these stocks which heavily benefit from such investment will tank. However, if the AI CapEx super cycle lasts for years, let's say more than 3 years, we are in a much better position. And here is why. AI infrastructure serves two main use cases now. One, the first is training the model. So you see like OpenAI, XAI, Google, they are releasing a new model every few months. So this model needs to be trained, right? So this is still a lot of usage of workload. Then the second use case is inference, the actual usage of models for real world applications. So when you ask a query or any question to ChatGPT, that is inference, right? So over time, inference will overwhelmingly dominate in terms of resource share. As AI becomes a new way of doing everything and penetrates everyone's life and industries, even when demand for new chips and infrastructure cools down, which eventually happens, AI cloud providers like AWS will keep invoicing customers as before. Meanwhile, their cash flow will spike as capital expenditure decreases, right? So revenue growth will take a hit, no doubt about it. AWS, Azure, they are growing from 20 to 30% year over year. So this growth will slow even higher if you consider just the AI part. But at the same time, they will print higher profitability, which partially offset it. Why? Because they will decrease the capital expenditure for new chips. So the stocks of these companies likely will reprice, but they will not hard crash. This is what I expect. So this is the revenue trend I expect from this category, alongside the AI capital expenditure trend, assuming demand and therefore CapEx lasts long enough. Let me make it bigger. So you see in red, you have the AI capital expenditure, so mainly new chips, new infrastructure, new data centers, that at a certain point will flat and then will cool down or probably will go down dramatically, at least for a short period of time. And you will have the AI infrastructure companies' revenue that at this point will not go down. They will surely decrease their growth. But at the same time, there is not a line for this year, but the profitability will go higher. So sure, they will be repriced, but I don't expect they will crash hard, which is very important. Now, which are the stocks which I have picked in this category? Well, actually, it's just one. It's Nebius. So why Nebius? Well, Nebius will get, in my view, the universal substrate for agentic computation in application software. What does it mean? Nebius belongs to the neocloud category, right? Like the others, Iron, CoreWave, to mention some, meaning a new kind of cloud provider built from a ground up for AI, where GPU-dense infrastructure, AI-native tools, and model-centric pricing replace the old generic compute cloud. So what differentiates Nebius from the others are three things: top-level management, availability of capital, and a clear mission, which is becoming an hyperscaler. And if you want to know more about this, about what I see in Nebius, what's my thesis, then go to lorenzo2sense.com, where you can find my initial deep dive and the next update I did on the stock. So on this last point, guys, so purpose of becoming an hyperscaler, Nebius is purposely building a software layer on top of the data center hardware to orchestrate computing, aiming to reach top-level performance and compute efficiency while locking in its customers. And they also recently launched Token Factory, which I think is a big step forward. This lets you build enterprise workflows using different LLMs simultaneously with top-level efficiency. So I believe, long short, open source models are catching up, and I believe in the future you will do most of your AI work using open source models because they will be good enough. Then, of course, for the most powerful use case that you need compute, then you will still be using closed model, no doubt. I'm not saying that closed model are going out of business, of course, but you will have probably a mix of those. And already now, what is building Nebius, it's a software layer that allows you to use different models, open source, and then of course you can even combine with using API for closed source model. So probably, given even the level of governance that Nebius is allowing, you as an enterprise will want to build on Nebius. That will be your platform to develop, right? So I expect these characteristics will make Nebius compound for the foreseeable future. And in the next final episode of the series Invest in AI and Avoid the Bubble, I'll dig into the rest of my indirect plays and explain which categories I'm avoiding entirely and why. And of course, knowing where not to invest is just as important as knowing where to invest. So stay tuned and see you soon. Ciao.